Welcome back to this special MPC broadcast. The Reserve Bank Governor has announced that the repo rate remains unchanged at 8.25%. We're going to get some analysis now from Xhanti Payi. He's an economist at PwC, and via our online link, Chief Economist at Nedbank, Nicky Weimar. Thank you very much to both of us for joining, for speaking to us on this first MPC of the year. Xhanti, let me start with you. Of course, the market had expected largely that the rates would remain unchanged. But what did you discern from the tone of the governor as he spoke?
One of the things that I heard him say, which maybe he has been saying, but I just haven't been grasping, is this idea of the target. So he kept talking about the target. Now, we have a target band. We don't really have a target. And he talked about the target. And from what I'm discerning, he's now talking about the midpoint. That 4.5 is probably now what our target is in terms of the language that he's using. And he uses that quite strongly. He says, until we get to the target, because you'll remember, he gave all of these numbers. There's a series of numbers in terms of where we've been and how, this decline has not been a straight line. Certainly it hasn't been, and it never comes in straight lines anyway. It's the same as it rises. But certainly what it seems that he's looking for is looking to get to 4.5 and stay there for a while. And then maybe we're in business.
Nicky, I mean, that sounds rather unrealistic. I mean, there's a whole global conversation as to whether global inflation can come down to the sort of international standard of 2% in European and US markets. So what more South Africa getting to an average of 4.5% if the rest of the world is probably going to only average around 3%, if that?
Well, our target is 4.5. So, I mean, so they have quite a while ago started communicating that what they really want to do is center inflation and inflation expectations around the midpoint of the target range. So the reality is that if that's your target, whatever the rest of the world is doing, if you want to sustain and maintain the Reserve Bank's credibility in the fight of inflation, you've got to take that target seriously, and you've got to take the actions to ensure that you meet that target. So I don't think it's unrealistic for us to anticipate that inflation will go towards 4.5%. We are seeing the beginnings of that gradual descent towards that level. We don't think we're going to get there in the first half of the year, but towards the end of the year, we do actually see inflation moving towards 4.5%. As for the rest of the world, I don't think it's clear cut that inflation is going to average 3%. There's a lot of things that could go right from the inflation perspective. If global growth slows, inflation could decelerate faster than anyone's anticipating at this point. Most analysts, I think, globally acknowledge that. But of course, at the same time, there's also a lot that can go wrong. And I think that sort of 3% is sort of the balance of that risk. And it actually helps South Africa to achieve our target because inflation is moderating. It was much, much higher globally last year than it is anticipated to be, than it is at the moment, and than it is anticipated to be in the year ahead.
Xhanti, it's always interesting speaking to economists because a lot of the conversation is if, but. So in the meantime, what did you gather from the risks that were flagged by the Reserve Bank Governor? Of course, all of us were hearing about the geopolitical situation, which could impact on something like oil. And if the oil price went up to $100 a barrel, then that changes the whole picture for inflation for the balance of the year if things get very hairy, and they could within the next couple of days.
Sure. I think that's exactly the point. I thought that was interesting because it does really talk about oil. And he says this price is relatively high now. Many of us remember the days of $120 of oil per barrel. And that was high. And certainly those days seem to be so far away from us. But certainly in terms of what we are really saying around how the risks, because whenever we talk about ifs and what ifs, those are actually reflecting the risks that exist in the system. And then, of course, it talks really about some of the challenges that we face domestically on energy prices. Now we know Eskom goes regularly to their regulator to ask for more increases. And that has serious impacts to inflation and to the consumer. There's certainly, as he talks to the issues around our logistics, which also will have an impact. We're hearing the stories now that as we thought we were trying to resolve these things, there are now new backlogs in Cape Town. The farmers are unhappy about that. So certainly there is a lot of risks in the system that seem to be, and very little that suggests that those risks are abating, especially when it's said around energy, that all the calculations that they've made in terms of the quantum of electricity that's coming into the system, that looks like they're forecast enough for now.
Yeah.
And we're not going to see them adding any forecast into that. That suggests that we are still quite constrained. And I thought one of the things that was also encouraging is to sound this message that we are actually in restrictive monetary policy territory right now. So let's understand that that's what we are. And that's an important message because it suggests and it communicates to everyone that we are doing our best to make sure that we are contending with this problem. So we are no longer at a place where you can think that we are lazy around it or we are not committed. We are committed to this cause, and we are actually going to, and that's important because that actually is part of how you anchor these expectations.
Yeah. So restrictive monetary policy suffocates the consumer, and of course that's what we're going to be looking at after a short break. How does this all affect the consumer? Things have remained unchanged, but of course a number of variables continue to affect the consumer. We'll take a look at that after a short break. We continue with our special MPC broadcast. I'm in conversation with Xhanti Payi Economist at PwC and Chief Economist at Nedbank, Nicky Weimar. Thank you very much for continuing to join us here on the SABC News channel. Nicky, coming to the consumer, with this no change in interest rates, of course, there are lots of other variables that are affecting consumers. How does this affect the consumer?
I think as long as interest rates remain at current levels, as the governor and the Reserve Bank themselves acknowledge, interest rates are currently at levels that are restrictive, which means that it is squeezing the economy, it is squeezing consumer incomes. And now we're talking really about what is left after you've serviced your debt, right? So the income available for discretionary spending, and we've seen that has declined quite significantly. And for a lot of households, they might actually now also be experiencing severe stress because on top of the rise in interest rates and the fact that your existing debt burden costs you more, what we've seen during the course of last year is as that pressure continued to mount, households started to dig into their savings in order to sustain the spending, and now those savings are largely depleted. So now they're totally exposed to the pain. And what we have seen in all the retail numbers and also in bank credit numbers is a fairly significant slowdown, and in some cases even a contraction in spending during the final quarter of last year. And the governor themselves refers to that in the MPC statement.
So, Xhanti, I know at PwC, it comes out with reports on what's happening in the banking sector, how the consumers looking and all of that. So does this mean that we're now going to see the banking sector being even more risk averse when it lends money to people? And, what are we seeing in terms of consumers not being able to keep up with paying their payments?
Well, interestingly, the governor speaks of it very frankly when he says, monetary conditions or financing conditions are quite tight. And he even quotes the financing conditions for countries. So South Africa, he says, our bond rates and the long-term bond rate at 12%. So that's really, really tight. So, governments are struggling to borrow at rates that, you are actually not as worried about in terms of your fiscal conditions. Businesses are really, really struggling, even those who are looking at opportunities. Because one of the things we've been talking about is that, during this crisis that we are facing, we are also looking at opportunities. There are opportunities in the market. But of course, those opportunities are really hard to take advantage of if you are facing these kinds of conditions that businesses, banks are already have been telling us that they are having these non-performing loans. And I think Nicky speaks to it very clearly around, people have used what they had. And now to try and finance that debt, people are borrowing to pay the other loan. So those are the kinds of conditions that are being faced. But certainly businesses are under a lot of strain. And that is something that, is something of real concern. But I think it's reflected in this growth number that he reflects today of 0.6%, that we can't see that given all these conditions that are being faced by whether you are a farmer or whether you are a technology firm, in order for you to continue to invest, in order for you to sustain yourself, you're going to have to go to this market that actually is finding itself in a very, very tight spot. So it's a very sad and difficult space that we're in. But again, one of the things that we are now dealing with are all these polycrises, that you're not looking just at your funding requirements, just looking at your logistics that are under pressure, you're looking at your energy that's under pressure, you're looking at costs of your labor that you're going to have to really manage over the coming year. So all of these things require leadership that many of us don't have.
Nicky, very quickly, before we go to a break, I mean, is there any silver lining? 0.6% growth for the year 2023 is, it won't go anywhere near denting our high unemployment levels. But do you see any prospects of job creation in this economy at this time?
Okay, so the silver lining may perhaps not lie in job creation. I think it is in the fact that employment growth has recovered during the course of last year, and it's actually in fact risen. Employment levels have risen above pre-pandemic levels by the time we got to the final quarter of last year. Now, it was coming off an excessively low level that was caused by the shock of the pandemic, so we don't expect that it's going to accelerate at that same pace. We are seeing pockets of industries where there are retrenchment announcements in mining, manufacturing. But in most industries, I think the good news is that given that they're operating with fairly low staff levels, we're not going to see necessarily massive waves of retrenchments. But clearly, with the economy limping along, it is a bit of a worry and it remains a threat. But at this point, a sharp rise in unemployment is not in our base case. And I think the upside here is really that inflation is coming down. It's coming down globally. Oil prices, they are high. And yes, there's a lot of risk, but still they haven't shot up to the sort of levels we saw in 2022. So that is a lot better. Globally, food prices are receding. The fears we had around El Nino, that seems to have faded. And we've had good rains and farmers are reporting good crop estimates out there. So it doesn't look like we're going to have that shock coming through. And so as inflation starts to come down, the fact is that most industries have seen higher wage increases during the course of last year. And that means as inflation falls, the real wage, the governor talks about so often, that real wage will towards the end of this year start to get a kicker and it will start to improve. And for me, if you want me to identify a silver lining, that's what I see.
Well, quite a positive perspective there. We're going to go for another quick break. I'm in conversation with Xhanti Payi of PwC and Nicky Weimar of Nedbank. Join us after a short break. Welcome back to our special MPC broadcast. Xhanti, thanks very much for staying with us. And one of the issues that the Reserve Bank governor referred to, and he always talks about this, we are a commodity exporting nation. He talked about the fact that commodity prices fell by about 27% last year, and there's an anticipation that they'll fall by a further 12% this year. Of course, that's not great for us because, number one, lower prices is not great for profitability, sure. But we also have our logistics problems, which you've referred to. So even if we do produce stuff, we can't necessarily get it to markets. What does this mean? And when he talks about a widening current account deficit, why should we be concerned about that?
Look, I mean, it's something of real concern. And as you say, these companies have been under a lot of pressure. Some of them have cut production actually forecasts. That tells you, because they're looking at this and they're saying, look, there's no point in actually increasing production when I have these soft prices and I can't get the stuff out anyway. And that, in the first instance, does hurt what they pay to SARS. Because, we remember the years where we could get that nice kick from the mining sector in terms of the revenue that we collect at the Treasury. That's something clearly that's not coming. But also that deficit really is a difference, of course, between what we export and what we import. And whatever that deficit is, that gap, we need to find something to close that with. And that usually then means if we don't find something to close that with, the rand then will depreciate or it will lose its value. And that loss in value is what tends to be inflationary because, as we know, we are net importers. So then we import all of these goods and services at higher prices, and that affects the exchange rate. So that is really the serious concern around these softening prices and this lower production and the less of the exports that we have. And it's something that we should be concerned about because we know last year we spent a lot of money importing solar panels and other capital goods that we needed to invest in the economy. And if we continue, this big bulk of imports that will kick in terms of that imported inflation, and that's something of serious concern.
Yeah, that will hit us hard. Nicky, one of the things that the governor spoke about, he talked about the current geopolitical environment and the uncertainty around when interest rates are going to start coming down, creating a lot of investor uncertainty, and therefore there might be a reluctance to actually invest. So when it comes to a market like South Africa, how concerned are you around people's appetite to invest in South Africa, whether it's in our capital markets or actual FDI, foreign direct investment? More so because we have an election, but then so do some 50 or 70 other countries this year.
Yes, this is the year of elections. I think it's a very uncertain year. There's a lot of things that no one can predict, and anyone who claims that they can really are misrepresenting, their wisdom here. So, from our perspective, I think what ultimately drives fixed investment and the willingness of certainly foreigners to put capital down in a country is your relative return versus your relative risk compared to countries with similar risk profiles than South Africa. Now, on that front, we don't look good, unfortunately, because our growth rate has been hurt dramatically by all the structural problems we are facing, specifically the energy constraint and also increasingly the collapse of the rail network, the inefficiencies at the port. All of that have combined to really put a stranglehold on economic growth. And it remains an issue, and it will continue to limit the extent to which we can accelerate growth. At the same time, obviously, we have got very significant risk issues. One of those risk issues is, of course, the deterioration in our fiscal position. We are running much wider budget deficits than we budgeted for, and we have seen an escalation in our debt burden. We still have state-owned enterprises that are really financially in an extremely weak position and requires repeated and very demanding bailouts. And that poses even further risk to your debt outlook. And all of that risk has been priced in the bond yields, especially at the longer end of the curve, which the governor refers to. So I think when we talk about foreign direct investment into South Africa, all of those issues obviously weigh on our ability to attract both portfolio capital flows and physical fixed investment.
Yeah.
But ultimately, at the end of the day, we have to address all of these structural issues. And if we show a commitment to deal with them, something like energy could also be an opportunity to attract foreign direct investment.
Yeah, Nicky, we're going to hold
the point where we're going to get this sort of accumulation, that's still quite some way off.
Thanks very much, Nicky. We're going to hold it there, and we're going to go for a quick break before we conclude our show. All right, this is our last section of our MPC analysis with Nicky Weimar of Nedbank and Xhanti Payi of PwC. Xhanti, when it comes to the actual Reserve Bank Monetary Policy Committee, there's been a lot of controversy around Kuben Naidu just leaving suddenly, all of a sudden, and the public not being informed. We thought that the president would tell us that he's released him, etc., etc. But how concerned should we be that the Reserve Bank Committee is one man down or one woman down?
Look, I think the important thing here, and something that the Reserve Bank has done very well to try and do, and which we need to keep up, is that this should be thought of as an institution above individuals, so that actually even if the Reserve Bank governor were to be run over by a bus, that the institution itself is secure, that is beyond one person, that there's a committee of people who engage in these things. And I thought it was actually interesting when he said that this decision was unanimous. That usually communicates that there's a level at which, policy discussion, they're all starting to get each other. And that actually we move to, because, you start, of course, in terms of where are we right now? Are we cutting rates? So it looks to me that actually we are starting to see, there's a direction in which we're going. But certainly it is something that we have to think about it as an institution rather than an individual. And individuals will find opportunities, they will come and they will go. Kuben probably found a nice opportunity. That's how we should think about it rather than anything else. Because if we start to speculate then that might actually weaken the institution. But you are quite right that the communication could have been better.
Absolutely. And Nicky, just your thoughts on this particular issue. I mean, you've been in the game for the longest time. You've made your observations. How long has the Reserve Bank gone without a full complement of MPC committee members?
Not very long in the past. So, yeah, it's a rare thing. So they'll have to get onto it, I think, very, very quickly. But of course, they might have made proposals. They might have made a recommendation, and it's now up to the president to ratify it. So at the end of the day, I think he is ultimately the one that must make that decision. It is not the Reserve Bank.
Yeah. And then very quickly, between both of you, I'll start with you, Xhanti. To the 21st of February is a big day, budget day. What are your expectations? And everyone always says it's the biggest budget of the year. What are your expectations?
It has been the biggest budget of the year for some time. And, and he's got some really tough choices to make. We say this all the time. But certainly, one of the key things is really how he actually speaks to the debt problem that we're facing. That's a huge, huge thing, especially because he's been accepting and taking so much of the debt, whether he's taking debt from Eskom or he's taking debt from Transnet, at a place where actually, of course, our revenue outlook is not looking particularly good. So that's one area. But one of the things they talked about, which I'm really looking forward to we're looking forward to hearing, is the idea of, how do you get the private sector fully engaged in terms of co-investing with the government in some of these projects, because we need, their inputs here. I mean, if we're borrowing at 12% and we've got revenues that are not robust, you do need the private sector to co-invest. Yeah. And they need to put some really good framework. And so I'm hoping that he will announce something around the framework.
Yeah. Nicky, very quickly, our electricity minister, Dr. Khosiyenso Ramakgopa, was saying that there's an insatiable appetite for investment among private sector players. Is that the case?
I think he was referring specifically to investment in renewable energy, and I think that is true. We all recognize that it is, if we can get that going, and if we can make that work, whether it be in additional renewable energy capacity, the actual generation, or whether it be in the grid, and we can resolve that one constraint in the South African economy, we can make a big difference to the economy's ability to grow faster, to employ more people, to make more profits for companies. So I think that on that score, it is true.
Yeah. Thank you so much to both of you for your contributions there. I was joined in studio by Xhanti Payi. He's an economist at PwC, and via our online channel with Nicky Weimar. She's the Chief Economist at Nedbank.